Well, first up, the concept of mean reversion assumes that after long periods of under or over performance, indices will return to their long-term averages. And in the case of South Africa, this may suggest that the stellar performance investors enjoyed in the last decade may not be so stellar in the future. So where does that leave the debate around diversifying your portfolio offshore? Jeff Blount is in studio to tell us. And let's just look at that South African case, maybe take a step back and put the performance in perspective where South African equities are concerned.
No, absolutely. I mean, if you look in South Africa over the last decade or the last 12 years, I think we've averaged about an 18% per annum return versus inflation of about 6%. So we've had a 12% real return for over the last 12 years, including the crash in 2008, which is a stellar performance. I think we can be very pleased that investors in South Africa have enjoyed that. The question is, does that repeat itself over the next 12 years? Or 10 years, and if you highlight that versus what the US did over the last 12 years, perhaps maybe not.
Jeff, it's very interesting. I mean, I heard a stat from, I think, John Bickard that said that South Africa's all-share index was the top performing equity market over 100 years globally. So that stat that you put out there, that 18% return through a global financial crisis is quite incredible.
Yeah, it is. There's an interesting relationship in that people often assume that high growth economies result in high equity returns. China's economy is growing strongly, therefore you should buy Chinese equities. And often there's actually a slight inverse relationship. In fact, it's more steady, slow growing economies that offer better equity returns. Mainly because if there's hype around a market or an economy, prices get bid up and then subsequent returns are relatively poor. Now, I'm not talking about bad economies or economies that are in implosion. Doesn't mean you're going to do well there. But generally, if you've got steady growth economies, often the equity returns are better.
Now let's look forward, because that's the important point. And where should we be positioning ourselves to take advantage of a trend from a global or a local perspective?
We did an analysis, and it's actually, if you plot the long-term rolling returns, I'm talking about 10-year rolling returns. So if you buy an equity market and hold it for 10 years, what did your returns look like? And what's really fascinating is if you take South Africa versus, say, the US market, through the 1990s, you saw periods where South African equities underperformed relative to US equities. You can always say that was the heyday of US equities.
It was the 1990s.
In the 1990s.
So US was king at that point.
US was king, and South African investors had kind of given up on South African equities. I mean, I'll caveat that. South African equities did well. They beat South African inflation, but no ways did they compare to US equities. If you then look at the 2000s, we've had a period where US equities, in fact, only recently did US equities go back to their 2000 levels. So that's 12 years of flat returns versus these phenomenal returns in South Africa. So without actually looking at valuations or economic sentiment or whatever else might be driving markets, what you've got is a period of the 1990s, great returns in the US, poor relative returns in South Africa. In the 2000s, you've had 12 years of great returns in South Africa, poor returns in the US or in global equities for that matter. So the observation we'd make is if you talk about mean reversion, if stock markets and equity returns revert back to long run averages, the indication would be that, well, perhaps the US and global developed markets might do better than South African markets. Now, we're not saying negative returns for South African markets, but you can't just keep outperforming forever. So from that perspective, our advice to our clients is, well, perhaps consider a little bit more diversification in your portfolios, have a little bit more offshore, a little bit less onshore. But what was really interesting is if you do this analysis in rands or dollars, so we look at these global returns in rands or dollars, and you look at the South African returns in rands or dollars, it doesn't matter. What mattered was that you owned US equities in the 90s and South African equities in the 2000s. It didn't matter what...
The currency had no impact over long term.
Currency had no impact. So while the rand weakened over the 90s and strengthened a bit in the 2000s, what actually mattered was what the asset was, which is really interesting because everyone says, well, where's the rand going? Is the rand weakening? Is the rand strengthening? Maybe I should take money offshore because the rand's going to weaken from here. Or maybe I should take it offshore. It's just weakened and it might weaken further. But the reality is, in fact, you shouldn't be basing your decision on where the rand goes. It's actually, again, the asset that you own. So your decision is not, don't decide to be on offshore on currency. Look at the asset that you own. And on that basis, I suppose, while South African equities are good value at the moment, they're neither cheap nor expensive. So they're at okay valuations. So are US equities. So which means, well, if you're going to bet on mean reversion, I'll put money on the US.
The US, what about the EU and Japan? And I know you
Yeah.
guys are value managers,
Yeah.
so Japan and Europe would imagine would be a good starting point for
That's
you.
interesting
Yeah.
because in hot stocks we'll be talking about Europe versus the UK versus
Okay.
US versus Japan.
Okay, now that's a great question. Funnily enough, we don't think there's not much dispersions in the valuations. We use a cyclically adjusted PE in valuing markets to say is the market expensive or cheap. South Africa is at 16.5. The global equity markets in aggregate are at 16. The US is at 18.5. Europe is a little bit cheaper than that, and Japan is a bit more expensive than that. So from a valuation perspective, you probably want to tilt your portfolios maybe to global equities, maybe to Europe, but the valuations aren't compelling to say, well, hang on, there's obvious places you want to be. Caveat maybe Southern Europe and one or two central or developed European stocks, which are looking very attractive because they've been priced for European disaster, but you've got global exposure. BMW is a case in point. It's priced for European anemia, poor growth. Its exposures are global.
Just again, going to what we'll be showcasing later in the programming in hot stocks, the indices, would you at all be interested in the S&P 500 as a barometer of the US equity environment or the Euro 50? Euro Stocks 50.
Yeah.
And just to interweave with that question is also the all-share index is a large component of foreign earnings. I mean, is it even a barometer of South Africa, to be fair?
Yeah, well, I mean, the thing is that all markets are internationalizing. You know, the US, Europe, and South Africa, increasing components of their earnings are driven by global companies. To answer your question, while I'm saying over the next 10 or 15 years, we think that the US market on mean reversion is probably going to do better than the South African market. It is slightly more expensive than the South African market as we currently speak. And secondly, one of the concerns that worry us there is that earnings of the US as a percentage of their GDP are at record highs. And I think the number off the top of my head is 10 or 11% of earnings is as a percentage of US GDP. In Europe, you've got markets that are slightly cheaper, trading on lower multiples, and in fact, earnings there are not at a cyclical high. So from that perspective, it's not just about the PE you're paying, but look at the nature of the earnings. And we think that the US is at a cyclically high earnings base, off a slightly higher multiple. So in the near term, sentiment might drive the US up and exuberance. I'd be a little bit wary if I was placing my money overseas to pick the US at the moment. But again, I'm saying on a 5, 10, 15-year view, we think that global equities and US equities are probably set to outperform South African equities.
Jeff, just a question around the equities that you like to purchase. When you go into these markets and people look and they think, what's the best way to do this? There's some great brand name companies that you can buy overseas. You mentioned in your research that you take the opportunity to buy companies that you can't get exposure to in South Africa, the likes of which BMW and other tech companies like Samsung.
Yes.
But in terms of the type of stocks people want to buy at this point, dividend-paying stocks still the best way to go?
Look, in the global search for yield, you're seeing that people have got increasingly excited about high dividend sort of cash cow stocks. Interesting enough, they still tend to be paying quite good dividends, even though market attention's been focused on them. So, you look at high dividend payers out of Germany and the US, you'd think they'd actually be more expensive than they are. But I think increasingly, 2 years ago, high dividend stocks were almost a no-brainer. You just wanted to be there because the yields were so attractive. These were great businesses, generating cash, paying the cash to shareholders. As the global search for yield has continued, it's pushed some of these stocks a bit more expensive. So I think previously you might have been able to shotgun it, but now you have to be a bit more select in terms of targeting high dividend stocks. But it's interesting. I think that suddenly with the US economy slowly getting back on track, people are maybe starting to refocus on, I think maybe that theme is running its course a bit, and now people are getting excited about sort of other themes and economic recovery themes.